everybody. Welcome back to Dhan Ki Baat. Since we have Samir again with us, we thought of doing another series with you all for you all to watch. Samir, suffices to say, he's the longest serving fund manager in the country today. And over this 27 plus years of his managing funds, he's made some very strong views on the market and how to manage money. And one of them is definitely concentrated versus diversified, how to manage the money there. So, Samir, I'll leave the forum open for you. Please share some.
Thank you. Some people may have already heard it in Hindi, but to make it convenient, we will do it in Hindi and English. So let me explain the whole idea once again. And of course, please ask me questions along the way.
Sure.
Okay, so the big picture is this debate on whether a portfolio, equity portfolio, should be concentrated or diversified. Of course, there might be different definitions of what is concentrated. But here we are talking that concentrated means all these guys who talk about 5 and 10 stocks and having maybe 90% in that, if not all of it. So the issue with concentration is that there are many big supporters for concentration. Warren Buffett says or said, diversification is a protection against ignorance. It makes very little sense for those who know what they are doing. And he also said separately that an investor should act as though he had a lifetime of 20 punches. What he means, I guess, is that you will in your life make only 20 decisions about investing, I guess. So therefore, be very careful and thoughtful before you do it. And we'll talk about all these issues. And then, of course, we have Indian fund managers saying bet seldom, but bet big and hold for the long term. So we will debate on all these things as to whether it makes any sense or not, even though it is coming from Mr. Buffett. So first thing is, let's talk about this line. The first issue is that you don't really know you are ignorant till something unexpected happens. When you are going in, you have got conviction, you bought a stock. If the stock does well, it will never be exposed that you were ignorant, because in the end, the stock has done well. Right. So first thing is, we don't know we are ignorant till something unexpected happens. It's not easy to say upfront. If you know this thing, then you should be, if you know you're not ignorant, you should concentrate. Second is, which is most likely, is that you will think that you are not ignorant and you will turn out to be ignorant, as I will show you many examples. And the other thing is, in a big picture sense, the strategy of concentration cannot work if we look at it across people. So let us say there are millions of investors and traders in the world, and only 100 of them choose concentration because they are not ignorant. Right. So each of these guys builds a portfolio of only 5 stocks each. And therefore, each of them has bought 5 stocks and is saying, I am not ignorant, so I am concentrating on these 5 stocks. Now, if there are 100 people, and even if some stocks are common or not common across these guys, that means broadly these guys own some 200-300 stocks collectively, on which these non-ignorant guys are bullish. Right. So how can all of them do well? If all of them do well, that means 200 stocks or 300 stocks are going to do that. So mostly what will happen is, out of these 100 investors, some 5 investors will do very well, because the 5 that they have concentrated on will do well. And then there'll be another set of investors who have concentrated by mistake or by ignorance on the wrong 5, because by definition, all cannot do well. And that means otherwise the whole market is doing well, which means nobody is doing well relative to the market. So therefore, it is not possible that a large number of concentrated investors do well simultaneously. And the other thing is that, as far as we are concerned in the fund management industry, where we are offering up products to our investors, it is very highly unlikely that that investor, even though he believes in concentrated strategy, will give all his funds to one fund manager. So if he likes me, he will say, okay, I give you one for a concentrated strategy. Then he'll find 3 other guys who also believe in concentrated. In the end, he has 3 funds that he's invested in. So he's no longer concentrated himself, even though each of his funds might be. So the point is, it really doesn't work so easily that if you know something, you should concentrate. The other thing is about this idea of having only 20 punches. So some 3 academics, these guys' names are written here, Hughes and whatever, Jing Liu and Ming Shan Zhang, They did the study of the Warren Buffett quarterly releases or quarterly statements that come out as to what stocks they bought, the Berkshire has bought. So these guys analyzed the data from April 1980 to December 2006. And this was the prime years of Mr. Buffett. And you can see that out of the 2,100 whatever quarterly observations that they found, the median holding period for Mr. Buffett was only 1 year. And 20% of stocks were held for more than 2 years, only 20%, and 30% were sold within 6 months. So neither was he making concentrated decisions in aggregate, but I'll do more explanation on that. And neither was he really holding them forever or for long.
But sorry, continue.
So I was saying he was doing exactly what many others do.
Right.
You buy many companies, what works you keep.
But normally people assume that, you buy these quality companies which have got good past history and hold them forever and
that of course, that is because some companies that you hold can end up doing well and they dominate the headline. So let's talk about that also. That in general, even if you want to concentrate, what will be the basis of your concentration? So somebody could say, I look at the passion in the eyes of the management. Now, most of the time, they can't see the management because if you're a retail investor, you are going to see them on CNBC. Somebody will say, I met them in a party and they were so focused. So, these are like 5-minute conversations that you have. But anyway, let's say that somebody says, I look at quality of management. First of all, nobody knows what it means. At least the regular public doesn't know what quality is. Second is we look at history of company management. What they have actually done in the past. Third, somebody could say, I will look at potential and projections and I have faith. Like there are some fund managers say, we think these companies will grow 20% per annum for 20 years. So we'll see that. And you can see financial numbers, same. So let's see evaluating management. Now, generally, fund managers whose full-time job is to look for companies and are able to meet managements and they have analyst teams so they can follow up and attend conference calls and go on plant visits. But even then, they have broadly, it has not worked. And for retail, it's not even available. So many opportunities to meet management is not even available. So you will have to do it from secondary sources. But let's look at people who were doing it primary data. And much more than what a fund manager may do. Because for fund manager, he'll come across the fact that the company is listed. So he can't get too much close to the management. The management will not give him preferential views and information. He doesn't have access. But academics and consultants and all that have that access because they will go in with the view that I'm writing a book on you and all that. So here is this book called Built to Last, trying to analyze managements with a view to learning about successful habits. Habits of successful companies. So they can then apply to a new company and say, oh, these are the habits which are similar. Therefore, this company will also do well. This is what a normal fund manager or in theory an individual investor can do. So these guys looked at companies that had done well from 1926 to 1990. And then they found by interviewing them and meeting them or reading about them that these companies have big, hairy, audacious goals. They have homegrown management. They don't accept good enough. They want very good or excellent. There is no tyranny of the or. That means they don't say A or B. They want to do both. God knows whatever. More than profit. They have a big picture purpose. So all these things look very good. That let us, when we are looking at a new company, let us have a checklist where through our interviews or through our questioning, we'll ask them, do you have the tyranny of the or whatever? Or what is your goal other than profit? And then the company management being well trained will say, no, I have ESG issues and I want to change the world and I want to help the poor, just like Miss World kind of interviews. And you'll say, very good, these guys' goals are more than profits. So these guys did it. And then they applied it to the companies which were there at the time when this book was written, which is in 1990. And these are the companies they identified having these great factors or whatever habits. And most of them have disappeared from the face of this earth. Whether it is Boeing, it's not disappeared, but Citi or Ford or GE or HP or IBM or Motorola.
Arora,
You see that these are
Dot
not the companies that anybody should have bought in 1990. But this is what research would have shown. Then there's another book called Good to Great. So these guys also did studies like this. They found
The author is common, right?
yeah, so the author, one of the authors is common, and
Right.
both the books have been great sellers,
Right.
but with different teams is written.
I got that.
In both of them, not a single company is common,
Common now.
which he found as good to great. But anyway, the point is now there's a different model. So unless you say the author is an idiot, he's a professor from Stanford, he was a McKinsey partner, blah, blah, blah. Okay. So here, now he has a larger team of researchers, he says, no, here, which at that time was large, like whatever. So he found, okay, now the habits have also changed. Now the habits are culture of discipline, technology accelerator, like flywheel, which means if one thing is going well, then it'll work somewhere else, and you will confront the facts. And then all these companies again disappeared. In fact, there's a third book called In Search of Excellence. That fellow companies also underperformed. Okay. So this is just 2 books taken out. We can't show you 10 books because we also don't know about 10 books. But broadly, the idea is that analyzing history to say, I know this thing, and therefore I will look for that. For example, if you ask anybody about culture or discipline, you go to a new management. What will they tell you? They'll say, we are very disciplined about costs, about hiring. Nothing else will be told to you, and nothing else you will see. Once in a while, you might find one example, but that example might be the exception. So, what will you know about all these factors? So, Daniel Kahneman, who's a Nobel Prize winner in economics, although the first Nobel Prize winner in economics who's not an economist. So, his book is very good. So, he wrote that basically you can't look for good managerial practice and say that that is what led to it. Because, for example, today, if we say that companies that have a good succession plan do well, because today you find one company, let's say HDFC Bank, and you say they had a good succession plan. So see, if a company has a good succession plan, they do well. But 20 years ago, 50 companies may have made succession plans. Right. And 30 may have not done well. So even there, they had, for example, today you may say that companies that do well have ESOPs plans for the whole employee base. And you might find that 20 companies that do well do have good ESOP plan. But it is possible that there were 50 companies that had good ESOP plan, but only 20 did well. So 30 other companies also had good ESOP plan, and they didn't do well. Therefore, ESOP plan, knowing or not knowing, would not have mattered. That is the point. That the factors that are good, many more companies have it. So on that day, 10 years ago, when you were analyzing, there were 50 companies that had good ESOP plan, 10 did well, and they had good ESOP plan, but doesn't mean anything. What would you have done in terms of identifying them, whatever, at the beginning? So now you can look at other things quickly, like Fortune Most Admired Companies, which is a good indicator of how people perceive these companies. So imagine that in 1990, Merck was the most admired, which was good management, I would think, if you look at that. And in 2000, it is not even there in the top 10. Philip Morris is not there. Rubbermaid is not there. Similarly, you see nearly every 10 years, these companies change. Some of these Apple types are going to be there for 1 or 2 decades. But broadly, these companies don't have a very long tenure at the top. And the top, we are taking it, as said by Fortune, most admired means generally the ones you would think you are willing to bet on. And this General Electric, of course, is the famous example where it was the most admired company in the world in 99. And the comments and the eulogy about, oh, what a great management, what great succession planning. They had 3 guys. When Jack Inmelt was made CEO, there were 2 other guys, and he blew it up. And the company nearly went bankrupt. So they had a good succession plan, 3 not CEOs, but second level who were trying, and then 2 left. When you have a good succession plan and you identify 3 potential candidates, then when the one guy is chosen, the other 2 leave, at least in the US. Because everybody knows that these 3 guys were in the running. So now is that a good succession plan or a bad succession plan that two had to leave because three of them
Hmm.
were equal to each other. So they did
Okay.
not accept one of them winning over. Now let's say talk about evaluating long-term growth. Oh, we will analyze long-term growth. The thing is that long-term growth is very difficult to analyze because very few companies grow 20% per annum type for a long time. So for example, this is just to show you in the last 10 years what has been the growth of these companies, which we normally take for granted that so many companies do well and can grow 20%. And recently I found a video which I'm going to show you, which is our friend Mr. Buffett and Charlie Munger talking about how to predict long term, not how to. They are saying the
Mm-hmm.
ridiculousness of doing it. So please listen.
Your cash flow requires projections. I would say that projections, while they're logically required by the circumstances, on average do more harm than good in America. Most of them are put together by people who have an interest in a particular outcome, and the subconscious bias that goes into the process and its apparent precision makes it it's fatuous or dishonorable or foolish or what have you.
The point being that he says that this is made by people who want to show, and actually the whole video link is there, you can see it and do it yourself. But broadly, the idea was that Charlie Munger and these guys are saying that how will you project? It looks very accurate. Oh, I have predicted 19.2% and 20% growth. And they say they've never done it even while buying businesses. Okay. So then somebody would say that we will look at history.
Yeah.
Now, history is a bit more logical, actually. That history, if he's done well for 10, 20 years, he should do well. But broadly speaking, the problem with history as a stock price doing well is that the stock price may have done well because at the starting point of that history, you were very cheap. Or at the starting point of that, the services were very underpenetrated. And at that time, there would have been less competition. Because you did well for so long, many new entrants came in, like today in the paint industry. So to say that you did well in the last 10 years when there were 3 competitors and now suppose we have 6, you may still do well, but there'll be more competition, more cost, more capex, blah, blah, blah. So it is not easy to just look at history and say that I will just look at history. Another logical inconsistency, if you look at history, is that now you're looking at 10-year history to say, I want to buy this stock for the next 10 years and concentrate. 10 years ago, what would you have looked at? Because these fellows did not have history, but we know they did well.
Right.
How do we know they did well? Because today we are looking at the companies.
Yeah, looking at
that. Another thing is, if you think that the same company will do well for the next 10 years, that means at the end of 10 years, when you have to find for the next 10 years, you choose these companies only because they would have done well for the previous 10 years. Therefore, the good companies, according to you, will never end. They will always remain the same. Right. Because they did well, on the basis of which I think they will do well. And if they do well after 10 years, I'll again say on the basis of the fact that they've done well. So obviously, it's not the case. So therefore, history is not going to be a good indicator. So now the thing is, okay, I will look at numbers and ROC and RO, because the whole idea is, okay, first of all, we say there's no need to concentrate. That itself is a conceptual issue because everybody who's concentrated cannot be a winner. There'll be some winner, some loser. And therefore, it's not the concentration which is the formula. It is being right or finding 5 stocks, right, which is very difficult. If you say, okay, I want to concentrate, then, okay, tell us the basis on which you will concentrate. So, history is not a good indicator. Talking about projections is not a good indicator. Looking at long-term growth, quality of management, it is not easy to find when academics could not find, professors could not find, people who had inside stuff. Inside means not illegal inside, but who could go into the companies could not find. So now you say, okay, we look at numbers. So what I did here is, I went back and asked broker Motilal Oswal to give me the whatever that fellow could find in the old reports on consumer companies. And so he sent me these 2 reports, which are very similar in date, like 2 months apart, written by the same fellow at that time. And this is a Nestle and Lever. So here, if you see, Nestle had whatever 35% ROC and 40% projected, and Lever had 65 and 69. And so
These
everything
also were lower.
yeah, ROC is higher for Lever, ROE is higher, P is lower, and generally we know
Growth also is more.
that in
higher.
those days Levers was a big great company. In Keki Dadi
Right.
State was there and all that, and so it was always an obvious good company, but it also had good numbers. So you would have concentrated at that time on Nestle or Lever, most probably Lever.
Lever, yes.
Of course, we didn't buy Lever, that is a different matter. Even. But look here at the performance of Nestle and Lever for the next 5 years. And Nestle and Lever both underperformed the market for 5 years. After having 35 and 40 and 65 and 70% ROC.
Samir, I remember this time you were the fund manager and you had a consumer fund also.
Buy India. So
Yeah. So you never had a Lever.
Alliance Buy India, which was to buy only pharma and consumer. And in that, the benchmark rate for Lever was 35%. And we
Right.
had zero.
Zero.
So look at it differently. This
I was an analyst, if you remember.
You were the analyst there. And look at it. And that was the period which had a tech correction.
Yes.
After having a tech correction, the Lever and Nestle can't outperform the index.
Right.
With 65% ROC.
Imagine that bad.
For 25 years or whatever, 23 years till 2 days ago, after starting at this point and concentrating in theory, you would have underperformed our Nifty. And suddenly Nestle outperformed. Now we can keep justifying why it was Nestle or on Lever. There is no way in real life, real time, you would have chosen this or that, or maybe some would have by fluke and some not. So that is not an answer to the whole, how to resolve this. So we say, basically, there is no question that long-term compounding works, but the problem is you don't know which stock will compound. Okay. And even Mr. Buffett, as I will show you, has not had the success which you think he's had in identifying long-term multi-baggers. Or
everybody takes his example only when they talk about concentrated. They say, look at Mr. Warren Buffett and how he's done it, and over so many years.
The thing is, Mr. Buffett has obviously for his life done very well. And so he's made some simple thumb rules, not for himself, but for you.
Okay.
Like, please don't every day find new stocks. Please invest in 20 stocks only. Know what you are doing, kind of thing. But I will give you actual analysis of that. Second thing is, who the hell told you are Mr. Buffett? Just because Mr. Buffett could do it, therefore I can do it. So it's like if your son comes to you and says, I want to be an actor or I want to be a cricketer, and you say, nahi beta, go and study. No, Dhoni became a cricketer and made probably 500 crores or thousands of crores or $500 million, not even 500 crores. He made it because he was a gifted fellow. So the fact that Warren Buffett did it, and only Warren Buffett did it, should make you nervous.
There's only a handful of guys.
They say that from year 8, 10, his dad was a broker and he went to the library and read all the books.
Right.
Most probably the viewer here is a 30-year-old working in a company and in the evening having 15 minutes to read and 10 minutes to see some CNBC. So how? But anyway, let's analyze Mr. Buffett also. And second is, if you think that you are Mr. Buffett's avatar, then please concentrate and write a book also, and we will read it and recommend it also. Okay, so what I did here is, I looked at Mr. Buffett's top positions as given in his letter. So therefore, you have the original image from the letter. In December 31, 2000. So he had American Express, Coke, Gillette, Washington Post, Wells Fargo. These are all the 5 that he reported among the, that means the concentrated positions. Now all we have to do, and 3 of them, he still owns, Amex, Coca-Cola, Wells Fargo, and the other 2 actually have become unlisted. So we don't know their exact performance in them. But these 3, he has now sold Wells Fargo, I think after COVID. But broadly over this period, he's had it for 20 odd years. So just simply look at the performance of these 3 stocks, including dividend, in dollar terms, and Amex and Coca-Cola and Wells Fargo, which he has sold at a worse price than now. Because he sold it in 20 only, when the prices were lower for Wells Fargo. All of them have underperformed the index. The index during this period of 7%. In this, there is no one, I am not doing any analysis, I am just showing you And Berkshire has outperformed. So how is it that Berkshire's top 3 holdings have underperformed, but Berkshire has outperformed? We have to take it. That means the rest of the Berkshire
The rest of the book.
outperformed.
Yeah.
That means the tail has outperformed. The 3 concentrated
Right.
ones have not added value. Now,
Right.
people will say, but 2000 is too old. Maybe, you're just choosing randomly a date which is done. So let's look at it for 10 years. So here we are looking at the data for 12/31/2012.
Hmm.
These are all his positions at that time. Coke, again, Amex, blah, blah, blah. IBM, Moody's, POSCO, PNG. So we can again look at the performance of these stocks to see that if you were concentrated in these stocks at that time, how they did over time. Some of them he may have sold along the way, but mostly what he would have sold, mostly I would think, is where he has done badly. Because what you do well, because his idea going in is to buy a stock forever. So if a company is doing well and the management has not disappointed me, he's going to hold it forever. Unless some stock has gone up vertically,
Right.
sold it, mostly he would have kept it. But even if not, okay, you tell us which stock he did not keep for the whole period, but big picture. So here you can see again that the stocks that he had on 12/31/2012, one stock has outperformed the market. But he has again outperformed.
Right.
His top, whatever, 10, 20, whatever stocks, and not 20, whatever, 10 stocks, not one has outperformed except Moody's, which is not even a big position. And these 2, 3, I think, must have gone private or something or taken over because we couldn't find a new price now. So along the way, they must have gone, or maybe he made good money on that also. Let us say on all of them he made. So even then, 4 stocks have gone up. But I don't think the other 3 have done that. Now he said, no, but he made money on Apple. So here is the first time Apple came into the picture in 2016. Now, when he bought Apple for the first time, he had 6.7 billion that he had spent. And that time, just because he may have bought it just a few months ago, before it was 7 billion, right? But at this time, he also had another position called Kraft, which he's not including here because he's calling it a controlled transaction or something. But you can see here that had a market value of 28 billion.
Right.
So that means his top position, at least at the end of 16, was Kraft. And then it was Wells Fargo.
Right.
And then he bought more Apple. So I'll come to that also. And then it was Coke. And then it was IBM. And then it was whatever. So let's first look at from 16 to now. Only 4 stocks have outperformed. One of them is Apple. And his number 1 stock, which he didn't include in the list, but was in the thing above, Kraft. 16 to now, which is 6 years. Each year means CAGR is minus. Again, the same Moody's and 1 Apple. Now, let us say on the day he wanted to buy Apple, he was not feeling well and he never bought it. And there's nothing left. You can't have it. Okay, I got 1 out of 20 that did well. And again, by the way, he's again outperformed.
Marginally outperformed, yes. That's what it means.
Now we say, no, let's go make Apple more prime. Then Apple is really bigger position. So in the end of 19, he had 35 billion in Apple. Sorry, cost price was 35 billion. And at that time, the market value was 73 billion. And then this Kraft had fallen from wherever. Kraft had become 13 billion, which was whatever, 28 billion. And because it fell, he had lost 15 billion on Kraft. But now this was the position. Now, first thing is, his cost, because I don't think he's bought much Apple after 19. Okay, you can go and check yourself. But broadly, he has put in only $35 billion in Apple. That 35 billion on a base of something like 700 billion. Or maybe 650, because market cap is some 700 billion. Now you can say market cap is not the same as AUM. Broadly it is, because maybe it's 10% less, because Mr. Buffett also does a lot of buyback of shares. So he keeps saying, I'll be very strict about buying back. I'm not going to buy it at any price. I don't think he's paying a 25% premium for buying back his own stock if he knows that the value of the real portfolio is 500 billion, but it is carried in the market at 700 billion, and I am doing a buyback. And he said it somewhere that we will buy it if it is 10% within our expected value. Because nobody exactly knows what the value of what is the AUM. Because if you own those rail companies that he owns, how do we know? And either does he know what is the real value of that in the sense unlisted? So nobody knows in that sense. But the market cap is 700 billion. You make it 600 if you want. He's put 5% of his fund. Now the stock has gone up is a different issue. We as a fund manager say that we can't have a very big position because at that position, at that weightage, some new guy will want to invest money. And so we can't make a new guy buy 20%. But for Buffett, he's like Mr. Jhunjhunwala. He put in money and the stock went up, so he kept it.
True.
You buy 10 stocks, 20 stocks, and one stock goes up. You're not saying, oh, why you have so much? We are saying don't risk yourself 20% thinking you want to run a concentrated portfolio. But here is the black and white from 19. Now we should see the stock performance from 19 to now of all these stocks. Again, very few.
Wow.
All of them have underperformed. He is again outperformed. And now one of them which is outperformed is Kraft. After falling in the last 2-3 years, it must be up, whatever it is. But you can see that it is not straightforward. And by the way, here I am talking about these airline and all falling 14% per annum. This is because I did not then see when did he exactly sell it. But it is public knowledge that in 20 he blew off all his airlines after COVID.
Right, after the COVID.
So he has not got these prices. He has got 50% lower prices because then the market went
that
up.
That time was,
So on that year, when he blew it up, he would not have lost only 14 and 24. He would have lost much more because we have not seen it decent. We just saying till now. Picture, right? So the idea is it is not easy. That is the story.
So where do you think these concentrated guys go wrong, Samir? I mean, where you have others also like Pabra and all who are there in this game. I don't think they've also done too well.
They are not in any game. I think they have lost the game already. If you see their performance, you can type. It's very easy to say name and performance. But anyway, the thing is that if you are, Mr. Buffett has not got it. So now how did Mr. Buffett say that we concentrated? One guy asked me on Twitter, but if he did not do it, why did he ask you? And why does he tell people? So I think that what happened is that his first few really did well. Whether it's luck or analysis or whatever, he bought 30% in Amex and all, and he did well. So over time, his concentration he wants. But he has actually not done well with concentrated for the last 20-25 years. So let us say in real life, he has 50 years of performance. By the way, we must first say that we own shares in Berkshire.
Okay. Yeah.
Mr. Irani, you are also an investor, and I am the largest investor. Secondly, I've been to Omaha twice. I have read every book of his, and I love him. But the point is, I am just trying to show that what he's done is just to make the rules simple for you. He says derivatives are a weapon of mass destruction. He buys derivatives. He shorts things. He says don't buy commodities. He was buying silver. Not now. Many. He buys debt. He does. He was unlisted. He does everything. You saw the number of stocks that he did. I mean, traded in that article. If you see what Mr. Jhunjhunwala did, he bought 100 stocks, of which say Titan did very well. So he kept it.
Right.
If you see Prashant Jain wrote a letter recently when he left HDFC Mutual, saying that from 2000, I think 3 or 4, I think 3, that in some whatever portfolios he was analyzing, that he bought 459 or some such shares over the last 20 years, and that he showed how much profit he made in different groups. So let us say he started that portfolio with 60-70 names in the portfolio for the first time. That means over the next 20 years he bought 400 shares. Obviously, he did not end 22 with having 400 shares in the portfolio, so he may have held 80, 100, I don't know. Which means along the way, every year he bought 20 shares,
20 stocks,
sold 18 shares or whatever. That is the model. That is also our model. Why do we have HDFC Bank? Because it did well. So buy many stocks and what you keep, which we'll explain. So now these guys who do these 10 stocks, 5 stocks, they concentrate. And if once or twice the concentration goes wrong, your entire history is gone. Because you went from 1 to 2, 2 to 4, 4 to 8, 8 to 16. At 16, you concentrated again on 5 stocks. And 1 or 2 stocks went wrong by chance in the same year. So you lost 40, 50%. So you're back to boom 3, 4, 5 years ago. And I will show you some examples of that. Okay. So this is the article from Mr. Pabrai, whatever, in this magazine. And he's saying that he was speaking to Charlie Munger. And Charlie Munger says that the best ideas that people put up, which means concentrated ideas, was simply the picks the managers had spent the most time on. When they spent the most time on these ideas, they were the most excited about them.
Right.
And when they put all these ideas together, things didn't go well. So it's like saying, I own an underwear company. Now, how do I do more research as an individual? God, I don't know. I'll go to the local Kirana and say, which underwear is selling? And he will tell me three of Lucky and 4 of Dollar and 5 of Page. And I've done my primary research. Randomly, you wasted 1 hour of your life. But because you wasted 1 hour, you're even more convinced about one or the other. The point is, here it is. When they spent the most time, they were most excited. And when they put all these things, didn't go as well. So how to control this? So how will you get conviction if you're not even allowed to spend too much time? Well, if you spend too much time, you can be subject to this bias, right? One more thing from this report I forgot to talk earlier, so let me show you. So this is Pabrai, who's supposed to be concentrated, talking to the public about Mr. Buffett. And he says in 2005, just a year before he met the students, God knows which students, he told them someone had sent him a Korean stock market guide. I have also seen it. It was put out by Citibank. He spent 6 hours on a Saturday going through this list, and he picked out 20 companies from that list, and he put 100 million of his personal portfolio into those 20 companies. May I repeat again? You were told by everybody that you're supposed to buy 20 companies in a lifetime. Barbara is telling us that Buffett bought 20 stocks in one weekend.
One weekend.
I'm concentrated because Buffett told him, this is the real life story. So therefore, all these are stories. I think these are the stories depending on how it works. But let me show you some more examples. Now, first I want to stop share, I guess, because I've understood how to do this. Okay, let's go this one. So now again, I have to do share.
Yes.
So here it is.
Yeah.
Monish Pabrai and the horse heading holdings catastrophe. So number 1 position, 20% of the fund went to zero. Zero. Okay, we leave it here. We go to the next guy. The point is, if you go to 20, if the 20% happens later in life, then all your years are gone.
Gone, totally.
That's the whole point. That you think it's happening. एक बार हो गया तो क्या हुआ? वो एक बार takes away years of return.
Right.
Okay, this is a very famous fellow. His name is Bill Miller. Okay, now can you see it?
Yeah.
Stock pickers defeat. So Bill Miller beat the market for 15 years in a row, each year separately. I think he wrote a book also called The Man Who Beat S&P or something. And then he concentrated on bear stocks in 2008. Now see what happened here. A year ago, his fund had 16 billion. Now it is 4 billion.
Wow.
He lost 58% of the money, right? But what happened? The fund is now among the worst performing in its class for 1 year, 3 years, 5 years, 10 years. So 10 years nikal gaye. Ab karte raho ki nahi, 11 years.
One single position took away.
Now he will say ki 11 years may have done well. Most of the money came in the 1, 3, 5. Why?
Yeah.
Okay, since you are very keen to know, I will tell you one more. So this story, which I will come to share screen, this one. This is the story of a fund. You can see it now?
Sequoia fund, yeah, we can.
So what happened was Sequoia fund, not the private equity. They have a public markets fund in the US. Must be the same gang. So in 1970s or something, when Warren Buffett stopped managing money, before he started this Berkshire, whatever, he took over Berkshire. If people ask him, what do we do with the money that you are giving back saying, I don't want to manage. He said, put it in Sequoia. So Sequoia was the like heir in one sense to the Buffett empire. And they did well for many, many years. And then they bought Valiant. And they made Valiant 30% of the fund.
Wow. 30%.
30%. Here it is. Sequoia didn't sell a single share. It ballooned to more than 30% of the fund assets. And obviously the fund manager became famous and everything. And then Valiant went to zero. Okay. Now what happened? They did not sell any share. So the CEO resigned. Analyst.
Right.
Actually, it's not written here, but you can search. Directors resigned. They got sued in court. They had to pay fines. I mean, for what? And here, look at it. Then this guy lost 15% in Washington Mutual and wrote this all the way to zero. If you can handle it, best of luck. It is not straightforward. And there are very, very few successful long-term winners of this strategy. You can be a fluky winner. We can't say much about that. Okay. Yes, sir. So I was saying these are the things. Okay. So one more thing, if you want to know, is basically on this halo effect. The halo effect quickly is that, if a company is doing well, you'll think it is doing well. So this is an example from this book called The Halo Effect about Cisco, that when the stock was doing well, the same magazine was saying, oh, great company, great management, great history, and great, everybody flies coach, they have customer focus. And when the same stock fell to $15, they curse the same company. That is life. If a company is doing well, he's a hero. Otherwise, we say he has no money, he's whatever. So that is the story. That if people think when you're concentrating, you make the assumption that very few companies do well. That's why you want to be concentrating. I think that is wrong. And second is that you think that you can identify in advance. So we've already shown you that the identifying in advance doesn't work. Because on what basis will you identify? Is it future? Is it past? Is it ROC, ROE, growth rate, management quality? Nothing you'll be able to identify. So the first question also we should debunk is that very few companies do well. Because according to us, a large number of companies do well. So let me show you that. So one thing is before that is that
that's what I was going to ask you, Samir. Now, I think most of our viewers will be convinced by now that concentrated is not the way to go. So how to go about...
Concentrated is a lottery in which the winner of the lottery is giving you a lecture on how he chose the number. Imagine everybody going to a conference where the guy says that I won the lotto and my numbers were 423112 and actually 423, 42 is my age and 31 is my wife's age and 11 is my birthday and therefore everybody says clap, clap, clap. So concentrated has no meaning. So quickly. So this is just arithmetic that if there are 500 companies in the universe, and our job is to beat the average return of that universe, which is called the index. That average will lie somewhere in the middle of that universe. That means some companies will, half the companies, broadly speaking, half the companies will do better than the index and half will do worse than the index. It is just the way average is calculated. So instead of half will do better than the index, half will do better than the average and half will do worse than the average. And our job is to beat the average.
Right.
And here you can see that if broadly speaking half, you can say 240 out of 500. Look at the performance each year of the 150th best stock. This
is S&P 500, the US
is for every index. I'll show you for India on the next slide. It is basically materially different from the index.
Right.
It has nothing to do with the fact that there is entrepreneurism and there is good management and these 150 guys are very good. No, it is arithmetic. Half the companies do better. Therefore, 40% do better than that, and 35 do much better, and 30 do sufficiently well for you to feel that if you got even the 150th stock of that market for that year or for that phase, you are sufficiently ahead of the index. And that is what we call creating wealth. If you can beat, index creates wealth. And you can beat the index really well, then you can create more wealth. Now, this you can do for India also because it has nothing to do with the average concept. I mean, it has to do with the average concept, not with the India concept. So here is the NSE 500 and look at the performance each year of the 150th stock from the index.
Right.
Imagine you can beat the market by 30% if you put, which we don't know how, but if you put, find the 150th best stock even. So if the average in the middle, some 30% of the stocks are doing very well, and actually some 30% of the stocks are doing very badly.
Very badly also.
So look at the performance of the 350th stock out of those 500. It's significantly worse than the index. That means your real job is that if you build a portfolio, may I please get 2 more stocks on this side then and 2 less on the other side.
Other side.
And we don't know exactly which stock will end up where, but you know broadly the factors that make a stock do well or badly.
Right.
And so all we are saying is make sure that those factors don't exist. For example, if we say a stock is very bad history, if a stock has very bad theme, whatever way you want to call theme, if a stock has bad industry, the way you want to call a bad industry. For example, for me, fertilizer is a bad industry. Oil and gas is a bad industry because there's too much government intervention, government interference. For me, infra is a bad industry because there's too much working capital blocked and revenue does not convert to cash flow, or EPS does not convert to cash flow, etc., etc. So whatever you define. So, or you may say that we don't like very high valuations in that which do well. We don't like them means we think that these things do bad. And then and don't buy them then. So then you are left with a universe which you say is not bad on any of my factors. And then you will so suppose you buy 30 companies. I'll tell you how many we do, but 30 companies you buy. So according to us, even broadly without any research, in theory, 9 should have done well because 30% do well. And 9 should have done badly. But if you put your effort and you put these 8-10 factors or 6-8 factors that we have, and you have some analysts and some fund managers and experience and you and whatever, then our 9 that are supposed to do well out of 30, if 11 or 12 or 13 can do well,
right, the average is still move.
That is also enough. Or if that also doesn't work out, at least the 30%, that is 9 stocks that are supposed to do badly, if you can reduce that to 5.
Right.
And the other 4 are not that bad, but around the index mark.
Averages, yeah.
Around the middle wala part. That also is enough. Right. And you keep doing it and you keep broadly doing well and not be exposed to any one factor, not be exposed to any one thing. And when the news is there and when the market is over, you can relax and not be hyper. That, oh God, I have concentrated. Because the concentration, the ratio of success is very, very low. So we look at stocks with a 1, 2, 3 year view, and we are only first saying, are you likely to do well or likely to do badly? And likely to do badly, these are the 8 factors. Not all have to be present. Even one of them is enough to say that it might do badly. But suppose you think it will do badly and it doesn't do badly. So what is the big deal? It doesn't matter. You didn't buy it. So you lost some opportunity. But since we know that 150 stocks do well, and I thought this stock will do badly and it did well, it's not going to do well on its own. There'll be another 149 companies that have to do well. And I can maybe get some of those, if not one which I thought will do badly. But probably the idea is you reject. And then you buy 2 kinds of companies. One is the group which is already well known, which is in a sense already discovered. You are choosing them, you are not discovering them now. Which in today's context would be an HDFC bank or an ICICI bank or some TCS or Bharti or whatever. Where broadly everybody knows they are okay and good. And then you are feeling that it is not bad on valuation, it's not bad on history, not bad on shorter term results, this, that. And you buy around 10, 12 stocks with a 50-50, depending on the market situation, basically half, little more or little less than half. So you're buying 10 stocks. And then the second group, we are buying another 20, 25 stocks, which are somewhat new, somewhat untested. Our stock has fallen a lot. Stock is down. COVID is there, so hotel is closed or something has happened. So IndusInd is down 70%. In all of them, or a new IP or a new thing where everything looks good, or at least not bad and many things good as we define, but you're buying 2.5% per name. So now, in theory, we know that we have 30, 35 stocks. We know that in the universe, 150 do so well that even if I get the 150th stock, that stock is very good. I just want from this 35, normally 10 should have done well. I want 15 to do well. And that mostly has happened. But you have not exactly ever known whose turn it is next.
So basically, your top end of the portfolio is fairly concentrated, right? With the heavy,
Our
with
whole
more weight.
portfolio is concentrated, depends on what is the definition of concentration.
Right.
When we sell to foreign investors, we say the whole portfolio has only 30, 35 names, which they believe is concentrated. But in India, the definition of concentration has become 5, 7, 10 names, which I think is ridiculous that anybody can have that much confidence. The idea is this, that you are like a casino, which means you have a small advantage over the gambler. That advantage is not so big, because if it was a big advantage, then the gambler will not come to the casino.
Right.
So the gambler should feel he can lose 4, 5%, but otherwise a fair game. And the casino says that if I play one time, you can win. But since millions of people are playing and I'm going to play it forever, the 5% is enough of an advantage over you. So for us also it's the same thing. Just because we checked management, we checked history, we checked governance, we checked accounts, still doesn't mean that 100% is covered. You covered whatever normally you can cover, and it gives you a small advantage. But that advantage, if you sell by one stock, maybe that fellow had done something, or his employee had done something, or that fellow was a fraud, but we thought he's not a fraud. You cannot put everything in one. And we have seen that not here. I showed you from Pabra to Sequoia to Bill Ackman to that Bill Miller. All of them can lose, and it depends on which part of your life you are in. And it can blow up 5, 10 years of your life. So in the end, we say that we can only go to this stage. After that, if you believe that you should concentrate, please concentrate, be successful, write a book, or do webinars, and we will come and see and then learn. Because our job is, we don't care. We want to do whatever we can, outperform the market and do well for everybody. But we believe that concentration doesn't deliver. But if somebody could convince me in black and white, then I'll have to change my opinion. But nobody in 25 years has been able to do that, either by their performance or by their lectures.
Thank you, Samir. Really a very informative presentation. And thank you, viewers, for watching this. And probably we'll see you again with some other topics in some point in time. Thank you.